Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CENTENE CORP quarterly report. CENTENE Corporation offers a wide range of businesses and services to underinsured and uninsured families, as well as commercial organizations in the United States. These include Medicaid programs, temporary assistance for needy families, Medicaid expansion, aged, blind, or disabled, children's health insurance programs, long-term services and supports Medicare plans, special needs, Medicare supplement, prescription drug plans, commercial health insurance, marketplace products for individuals, small groups, and large groups, clinical healthcare services, pharmacy services, vision and dental services, behavioral health services, federal management services, corporate management services. These services are provided through various channels, including primary and specialty care physicians, hospitals, behavioral health practitioners, and ancillary providers. The significant drop in CENTENE Corp's stock price over the past year can be attributed to a series of negative news and financial revelations in July 2025. The main causes include withdrawal of 2025 financial guidance due to unexpected issues in its Affordable Care Act, ACA, marketplace business, and increased medical costs in its Medicaid segment. Passage of the One Big Beautiful Bill Act, which cut $1 trillion from Medicaid, exacerbating investor concerns about Medicaid's significant contribution to CENTENE's revenue. Q2 2025 earnings report showing a rare GAAP diluted loss per share due to reduced net 2025 marketplace risk adjustment, revenue estimate, and increased medical loss ratio. These events led to a substantial stock price decline of over 46.28% in the past year, with analysts downgrading CENTENE's stock and lowering their price targets due to concerns about earnings visibility and uncertain margins in the ACA market. The primary drivers of revenue growth or decline for the company can be summarized as follows. Revenue growth is primarily driven by an increase in premium and trade receivables, expansion into new counties across 10 states, and successful execution of value creation initiatives. Specifically, the Medicaid segment saw a 9% revenue growth, while the commercial segment experienced a 10% growth. The Medicare segment remained stable. On the other hand, revenue decline is attributed to decreases in goodwill, lower Medicaid membership due to redeterminations, changes from the IRA, PDP business, and increased marketplace medical costs and lower estimated risk adjustment revenue. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between 2024 and 2025. Net income has decreased by $7.34 billion in the first 3 months and $8.59 billion in the first 9 months of 2025, compared to the same periods in 2024. This decline is primarily attributed to goodwill impairment and a decrease in premium deficiency reserve. In contrast, gross profit margins have shown an increase of 1.3 percentage points in the first 3 months and 0.3 percentage points in the first 9 months of 2025. However, the overall profit margin has declined significantly due to a substantial drop in GAAP diluted earnings per share from $1.36 in 2024 to -$14.50 in 2025. The adjusted diluted EPS also decreased from $1.62 in 2024 to $0.50 in 2025. These changes indicate that while the company has managed to improve its gross profit margins, it is struggling with net income and overall profitability due to various impairments and reserve decreases. The company's financial performance indicates a significant improvement in its ability to generate cash from operations. In 2025, the net cash provided by operating activities increased substantially to $4,651, compared to $741 in 2024. This marked increase suggests that the company is successfully managing its day-to-day operations and generating sufficient cash to meet its financial obligations. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's financial performance has shown a significant improvement in its debt level and interest expenses. The total debt has decreased from $18,533 million to $17,545 million, indicating a reduction of $988 million over the 2-year period. Additionally, net decreases in debt were recorded at $971 million in 2025 and $244 million in 2024. The company's interest expenses have also seen a substantial decrease. Interest expense decreased by $20 million, 3.8%, from 2024 to 2025, indicating a reduction in the cost of servicing its debt. This decline is consistent with the overall trend of decreasing debt levels and suggests that the company has successfully managed its financial obligations. Overall, these changes indicate a significant improvement in the company's financial health, with both debt levels and interest expenses showing a notable decrease over the 2-year period. The company's financial performance reveals a mixed picture across its various segments. The Medicaid and Medicare segments stood out as strong performers, generating significant revenue and maintaining healthy margins. In contrast, the commercial segment also showed respectable growth, albeit with slightly lower margins. However, the other segments struggled to keep pace, posting relatively low revenues and meager gross margin. This disparity highlights areas where the company may need to focus its efforts to improve overall performance. Management is expressing a cautious outlook on the company's future due to anticipated increases in medical costs and potential reductions in Medicaid membership. To mitigate these risks, they plan to take corrective pricing actions in 2026. Despite these challenges, management remains optimistic about the company's ability to navigate evolving regulations and promote cost-effective care through data-driven healthcare technology. The company is also expanding its geographic footprint through Ambiter Health and expects benefits from successful execution of value creation initiatives. Additionally, management has highlighted the importance of investing in system enhancements and computer hardware through capital expenditures to support future growth. Overall, management's strategy focuses on adapting to changing market conditions while maintaining a strong financial position, with sufficient cash resources to finance operations for at least 12 months. The company has a history of buying back its own shares as part of its financial strategy. In 2025, it repurchased $473 million worth of common stock and bought back 29,060,000 shares for $2.181 billion in the same year. Similarly, in 2024, it spent $2.2 billion on share buybacks. This indicates a consistent effort by the company to reduce its outstanding share count through share repurchases. That concludes the financial summary for CENTENE CORP. Feel free to comment below, and I will be happy to answer them when possible.